Most people think investing means picking the right stock at the right time, and that fear keeps them in cash forever. Here's the reframe. On a decades-long timeline, investing is less about guessing winners and more about owning a broad slice of the market and letting time do the heavy lifting. Today, what an index fund actually is, why fees quietly matter, how compound interest works for you and against you, and a simple beginner path that doesn't require becoming a day trader. If nobody taught you this in school, that's normal. That's why this channel exists. Quick note, this is general education, not financial or investment advice. I'll point you to official sources like investor.gov and consumerfinance.gov, and for your situation, check with a qualified professional. First split that clears the fog. The account is not the investment. A Roth IRA, a traditional IRA, a 401k, or a taxable brokerage account is a container. It sets the tax rules. Inside that container, you still choose what to own: an index fund, a target date fund, individual stocks, cash. People say, "I bought a Roth," when they mean they opened an account. Opening is step 1. Funding and choosing investments inside it are steps 2 and 3. An index fund is a basket. Instead of betting on one company, it aims to track an index, a list of many companies that represent a slice of the market. When you buy one share of a broad stock index fund, you own a tiny piece of hundreds or thousands of companies at once. You're not trying to outsmart every analyst on Earth. You're accepting market returns, minus a small fee, over a long timeline. That's the core idea beginners need before any ticker symbol rabbit hole. Fees look tiny, and they are not. The expense ratio is the annual percentage a fund charges to run itself. 0.03% versus 1% does not feel dramatic on day one. Over decades, higher fees take a quiet bite out of growth because you pay them every year on the growing balance. When two broad index funds track a similar market, the lower ongoing cost often matters more than the brand name on the app. Always read the expense ratio before you click buy. Illustrative only. Imagine $10,000 invested for 30 years at a 7% average annual return before fees. Knock 1% off for a high fee versus nearly nothing for a low-cost index fund, and the ending balances diverge by a lot, because the fee is charged on a growing pile every year. The exact market return is never guaranteed. The point is the mechanism. Small annual costs compound just like returns do. A simple mental order many beginners use. First, capture any employer 401k match if you have one. That's part of compensation. Then, decide which account wrapper fits: workplace plan, Roth IRA, traditional IRA, or taxable brokerage, based on eligibility and tax rules for the year. Then choose a broad, low-cost index fund or target date fund inside it. Account first, investment second, automation third. That order alone prevents most "I bought a random stock in my checking leftover" chaos. But here's the mistake that quietly wrecks beginners: treating investing like a game of picking winners. Hot tips, meme stocks, and "I'll wait for the perfect dip" keep people either overtrading or never starting. An index fund accepts that you probably won't beat the whole market after fees, and that's okay. Your edge as a beginner is time in the market and low costs, not predicting next quarter's earnings call. In about a minute, I'll give you the beginner investing checklist to screenshot: account, fund, fee, and habit in one place. But first, the other half of compound interest, the part that works against you. Compound interest for you means your money earns returns, and then future returns can earn on the larger pile, growth on growth. Illustrative example. Contribute $100 a month for 20 years and leave it invested. The later years matter more than the first because the balance is bigger. Starting earlier often beats waiting to invest more later with a bigger check but fewer years. Markets go up and down. This is the mechanism, not a promised return. Same math, opposite direction. On a credit card or other high APR debt, unpaid balances can grow because interest is charged on what you still owe, and then on the growing total if you only pay the minimum. That's compound interest against you. A 24% APR balance does not wait politely while you start investing next year. Understanding both sides of the snowball is how adults stop treating interest as a vibes word and start seeing it as a mechanism. Now, the one thing nobody tells you, compound interest is morally neutral. It does not care whether it's growing your index fund or your revolving credit balance. So the adult move is not never invest until debt-free forever as a slogan, and not ignore 29% APR because the market average is 7. Look at the rates on both sides. Employer match is part of pay. High APR debt is expensive. Index funds are a long-term tool. Put the pieces in order for your numbers and verify with a professional when it's personal. Pull it together into a path you can explain in one breath. Know the wrapper. Prefer broad, low-cost index exposure over stock-picking theater. Automate contributions so consistency beats motivation. Keep an emergency cushion so a surprise doesn't force you to sell long-term investments at the wrong time. And remember, past market returns do not guarantee future results. This channel explains how the tools work, not what you should buy. Here's the beginner investing checklist to screenshot. 1. Separate the account wrapper from the investment inside it. 2. If your job offers a 401k match, understand the formula before you skip it. 3. For long-term investing, learn what a broad index fund is and read the expense ratio. 4. See compound interest both ways, growth on investments and interest on high APR debt. 5. Automate a contribution you can sustain and keep emergency cash separate so you're not forced to sell in a panic. Run those 5 and you already understand more than most viral finance clips teach. So the takeaway? You don't need to pick stocks to start understanding investing. Own the idea of a broad market basket, respect fees, and treat compound interest as a two-way engine. Free download of the Beginner Investing Checklist is linked below, plus the Adulting Starter Kit. Subscribe for more plain English money breakdowns on the Adulting Guide.